Now, I want to make sure you get the big picture here. So let's take a step back and look at the lending business from further away. So there are two major mortgage markets. These are the primary mortgage market and the secondary mortgage market. See, when a home buyer goes out and they get a mortgage to buy a property, they are getting a loan to buy a property in the primary market. Now, the primary market can be thought of as the origination market or the original market. Now, the secondary mortgage market is where those loans are sold, often in the form of what's called mortgage-backed securities. Now, you can think of this market as the resale market. See, when you take out a loan, you sign what's called a promissory note, which means you are promising to pay the loan back. Now, the promissory note is secured by the mortgage or deed of trust, depending on your state, which is recorded against the property. So when a loan is sold, what's really being sold is the promissory note. So whomever owns the note is referred to as the note holder. Now, I don't want to go into too much detail here or get too technical on you here, but think of the secondary market as the way that lenders are able to get their supply of money replenished so that they can go out and lend more money to more borrowers. Does that make sense? Because really, if a lender wants to do a lot of loan business, then they need money to lend out. And if they're lending all their money out to different buyers and borrowers, then they're going to run out of supply. So in the secondary mortgage market, there are three primary big fish buyers of these mortgages. And you might have heard of them before. We're talking, Fannie Mae, Freddie Mac, and Ginnie Mae for conforming conventional loans, and Ginnie Mae for government-backed loans. Now, Fannie Mae and Freddie Mac are somewhat interesting in that they are government-sponsored entities, meaning that even though they are supposedly private, the government really has their fingers into how they do business, especially since the financial crisis of 2008, which they kind of pretty much helped create. But we're not going to go into that here. Basically, if a lender wants to sell their loans to Fannie Mae or Freddie Mac to create more liquidity so they can lend out more money, then they have to follow sets of guidelines that Fannie Mae and Freddie Mac put out. And basically, as long as a lender ensures that these guidelines are met and the rules are followed, they essentially have the guarantee that they will be able to sell that loan on the secondary market and then repeat over and over and over again. And assuming they follow these guidelines when lending, the loan is also known as a conforming loan. Now, non-conforming loans will often have either stricter guidelines, higher interest rates, higher scrutiny of the borrower's qualifications, or any combination of these, okay? So this is important to ensure that they have a safe investment for a loan that will likely remain on their books in their financial assets category for the long term. Now, you also have different government-backed loans. The primary two being the Federal Housing Administration Loan, or FHA loan, which you've probably heard about, and the Veterans Affairs Loan, referred to as the VA loan, which is only available for qualifying active or prior military service members or their surviving spouses. Now, these two programs are able to offer more easily attainable qualification standards due to the fact that the government insures them. Understand that the government isn't the one lending the money. Any lender following the guidelines for the specific loan type can actually be that lender. But it's the government entity that insures the loan to the lender or note holder. So in other words, if Bank of America followed the VA guidelines for lending on VA loans, and then they originated a VA loan, and 5 years later the borrower stopped paying, the Veterans Administration would actually be the one reimbursing the note holder for the loss. And because they are backed by the government, these loans are attractively easy for lenders to originate. And then they turn around and they sell them on the secondary market pretty quickly. We'll go into more detail on these two in a little bit. Finally, you have non-conforming loans, which do not comply with Fannie Mae or Freddie Mac's lending guidelines. The most common reason loans do not conform is because they are above the county loan limit that the Federal Housing Finance Agency sets each year. In these cases, these are referred to as jumbo loans. Overall, the terms, costs, and underwriting guidelines of these loans may vary from one lender to another. For example, although technically the VA guidelines do not specifically specify a minimum credit score for a loan, most lenders will set their own minimum requirement for borrowers. Now, when a lender adds additional requirements beyond the basic guidelines for a conforming or government-backed loan, these guidelines are often referred to as overlays. Now, next, we'll talk about some of the more specific benefits of FHA and VA loans, especially the first-time home buyers starting with the VA loan.